For more on this strong year-end rally and how to position for 2024, let's welcome Jeremy Bryan, portfolio manager at Gradient Investments. Jeremy, I'd like to welcome, number one. I'd like to get your reaction to what Michael just said there, but you say it would be difficult to say that we see this type of performance continuing at the magnitude we are experiencing now. And at the same time, you point out that now, with regard to market performance, a year after a big year, higher than 20% gain in the S&P 500, stocks are still up the following year, 65% of the time, and the average return in those years, including the down years, is about 9%. So that suggests that 2024, while we may have a correction, may not be a bad year at all.
Yeah, I mean, that's absolutely right. You nailed it. Our opinion is, just because you have a good year doesn't mean the next year is bad, right? We've been on a little bit of a seesaw, as Mike said before. We had a massive down year and then a really good year this year. It does not mean we have to continue on that trajectory. In fact, I hope at least, that we kind of normalize to a certain extent. And a 9% market is a normal market. Now, do we get that very often? Actually not. Usually you end up getting very highs and very lows. You usually don't get 9 to 10% all that often. But those numbers that you said show is that better than 50% of the time we're positive again the next year, even after a big year. So from our perspective, we're saying, hey, have a safety net and be cautious and understand that certain things are pretty expensive. Certain things are still a relative bargain. There's still opportunities out there, and it does not mean doom and gloom for 2024.
Mike, what would you add? I'm hearing a lot about this idea. I mean, I thought Bryn put it well earlier, this question of, are we about to make a double top? Or should we expect that once we see the kind of momentum we've been experiencing, that stocks typically keep going?
Yes, usually, strong returns for a while beget further strong returns. Now, all that being said, I'm not sure the market on a longer-term basis really owes investors a tremendous amount. The 3-year trailing annualized return of the S&P is right at 10%, so it's not as if you're digging out of some deep hole. If you've been a buy-and-hold investor, you go back, 5 years, I think you're up 16% annualized. So in other words, it's not as if this market has been down in the dumps and it's something that it's a recovery effort. But I do think you have to keep in mind, just any year, calendar years, they're up 70% of the time. Usually, you tend to have some kind of follow through. I don't think you necessarily want to, pencil in the most bullish gains. I think the biggest question, Kelly, from this moment is, are we still in a late cycle? How long can we stay late? Have we somehow gotten the fountain of youth based on the Fed pivot that we're back in mid-cycle? Because that's going to define, I think, how we absorb whatever comes at us in the way of the growth and inflation numbers.
So, Jeremy, I wonder to pick up on what Mike just said there about interest rates and so forth. There's an awful lot of expectation about lower interest rates seemingly baked into where we are right now. 150 to 175 basis points of cuts, maybe 6 interest rate cuts. That means every meeting they're going to cut, basically, if they do a quarter point at a time. That feels a little fantasy land to me.
Yeah, I think people need to calm down on it a little bit, because they were going the other way 4 months ago, right? In the effect of, they were assuming rate increases, and now we're assuming that amount of rate decreases. I don't see that. And here's what we've been saying is,
so what if the Fed doesn't cooperate? What would the market reaction be if the Fed doesn't cooperate, as you seem to suggest it may not?
Yeah, I think normalization could absolutely happen. Could we get a short-term correction as a result of that? Absolutely. But from our perspective, that's the buying opportunity, right? Is if we're looking at that and saying, oh, the Fed isn't cutting. Well, they're not cutting because economic trends are still okay. We still have a good amount of jobs, and maybe they're not cutting as aggressively as we had anticipated. But if corporate earnings are still coming in and market sentiment is generally driving us towards positivity, I don't think that is in and of itself the catalyst for a big decline going forward and saying, well, the Fed isn't cutting as aggressively. In fact, in our opinion, if the Fed's cutting more aggressively than anticipated, that's probably bad, because probably your economic trends are falling apart a little bit.